Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
Hey everybody, thanks for tuning in for this episode with Greg McKenna. Remember, new shows are posted every Monday and Thursday. You can subscribe to the show on iTunes and YouTube. Now, if you're enjoying the show, please leave a review on iTunes. Before I play today's interview for you, I want to give a shout out to the great sponsors of Futures Radio Show: CME Group, Trading Technologies, RJO Futures, and Top Step Trader. To learn more about these sponsors and the important things they are doing for futures traders, be sure to click on their logos on our website. Today, I spoke with Greg McKenna. He was a bank trader that is now a private trader. He is also a writer at Business Insider Research Australia. I asked Greg what he learned as a bank trader that helped him with becoming a private trader. We talked about the importance of mentors and building up a risk tolerance. Greg tells us the process he went through when choosing the best markets for him to trade. He shares with us his favorite technical tools, his process for position sizing. We talked about his entry and exit strategy, and finally, we chatted about linkages between markets. Without further ado, let me take you right to that interview with Greg. Greg, thanks for joining me.
Anthony, great to be here. I'm really looking forward to this.
I'm looking forward to it too. Now, I want to start off today by talking about your journey from a bank trader to a private trader. I mean, obviously there are differences in approach to those jobs, but what I'm curious about are the skills that you've learned from working in the bank industry that have helped you become a private trader.
Yeah, I guess the most important thing was risk and how to take risk and, deal with the stress, I guess, that many traders can feel day to day and minute to minute of carrying positions. I strongly believe that you build up a risk tolerance in the same way that you build up a tolerance to coffee or chili or those kind of things. And that what the bank approach did was allow me to be able to learn how to take risk in an environment where, you've got senior guys there. And I was lucky. I started in my sort of late teens at Westpac and managed to be on a desk trading. I think I started with trading limits pretty decent size when I was maybe 20, and so that helped me learn how to do that. And with the guys and girls around helping guide you and those kind of things, I think that was probably the more important thing. But equally, it taught you to look outwards as well and to have a focus on what's happening, at other banks and other markets, and not just on your own screen. So that was probably the primary thing was how to take risk, although they didn't manage it that well in many ways, and how to have look up from the screen and look outwards.
So to me, it sounds like building up your risk tolerance, and even more importantly than that, people, mentors, and the impacts they had on you.
Yeah, absolutely. I've been really lucky. I've had quite a few mentors, and most of them have been called Peter, which is really strange. But they've always kind of let me take that next step, that next level of trading of markets. And I started in money markets and started as a money market trader. And then, I did that. And when I ended up as a fund manager, which is, very similar to being a bank trader, I was given a decent sized money market fund. And then I was given, that was over $1 billion. And then I was given a $500 million bond fund. And then in the end, I ended up with those two funds plus a multi-billion-dollar currency fund. And that was all because of, my mentor at that fund just kept, encouraging me to learn more, to trade more, to look more, to read more, but not just that guy, but also others. And I was lucky in my very early trading experience to be taken under the wing of a senior trader at another bank, which I found amazing. He was just so generous with his time and taught me the ropes of what was a pretty volatile time in interest rates back in the early 90s in Australia. So that's been a really important thing, and that's something I try and give back to.
Yeah, for me, I could relate to that on a personal note. A lot of people know that I started on the floor of CME, and for me, probably the most important part, similar to your experience, was the mentors around me, and whether they knew I was watching them or if they didn't, either way, I was watching what successful traders were doing to be successful at trading. And you really just can't pay for that experience to see what they're doing and how they go about their business every day. And something else you mentioned was, so it's not only people and the mentor side of things, it's managing risk and how they go about doing that. And I want to talk about your current day process. So we know that you had this journey from a bank trader to a private trader. You had some experience, you had some good mentors, you learned the ropes, let's call it that. What's your modern day process like? Let's start off with, what markets are you trading and why are you trading them?
Yeah, so I've ever since I first wanted to get in markets when I was a kid, currencies were what really interested me. We floated the Australian dollar back in 1983, and that was the catalyst to get me really excited. And so currencies and commodities and interest rates are my three primary markets. I'm not a stock picker in that sense. Besides the top sort of 10 or 20 stocks on the planet, I don't really know the fundamentals. So my primary markets are foreign exchange. And the reason I like those is a couple of things. One is the macro driver, so you can have your fundamentals involved, your economics, your trade flows, your sentiment flows, risk appetite, all those kind of things. And so my process in approaching those markets is that each morning I get up, and basically since 1988 I've kept a little black book, or an electronic form of a little black book, which I turn into written material I share these days. And it's really just about looking at all the different markets and what's been driving them, how they tie together. That gets me really excited. Once upon a time, I was told that the currency fund for the fund manager I was working for was being closed down, and that I'd only be an interest rate trader. And I up and left and went to Westpac as their currency strategist, because it's the currency markets and the dynamics within those currency markets that really keep my interest. Importantly, though, Anthony, they go up and down. Currencies go up and down. And so part of my process is to use fundamental inputs, economics, sentiment, those kind of things, but also technical inputs. And that's a really important point for me, is that the fundamentals are really important, but I never, ever take a trade unless it's confirmed by my technical outlook. And that's really just a combination of MACDs and Bollinger Bands with candlesticks. It's as simple as that.
All right, we're going to get into more about the technical and fundamental side of things here in just a moment, but I want to talk specifically, I want to narrow it down to the specific markets you trade, because you say that you trade foreign exchange. That's what you like. But how are you going about picking what markets to trade? And the reason why I'm emphasizing this right now is because I think there's so many traders out there that look at all these different markets and they just try to trade what's moving. And I think that's a big mistake, because I've learned in my experience, when I jump around, it always costs me money. When I focus on maybe a few markets, tops for me, then I feel much more comfortable with those markets. I develop a relationship with those markets. So what markets are you trading? And talk to us about specifically what process you go through in choosing them and why you ultimately like those markets.
Well, I think you're dead right. You do develop a relationship with the market. I think I'd really sort of suggest any trader pick a market that they're mildly interested in and focus on it for a few weeks, and they'll completely understand what you're talking about with that relationship. You get to see the ebb and the flow of the price action. You get to see what drives it. But the way I look at things is I stick to liquid currency. So I don't trade emerging market currencies. I know that they move around, but I stick to the big ones: euro, sterling, yen, Aussie, CAD. I'm not very good at Kiwi for some reason. I think it's because Australia plays New Zealand in the rugby all the time. I always want to beat the Kiwi, so I try to leave that one alone. But they're the primary things. I trade oil, I trade gold, a little tiny bit of Bitcoin. It's a little bit volatile for my risk appetite. So those kind of markets, US 10s, US 2s, local interest rates, and so they're probably 10 or 15 markets that I look at, and I've got 6 or 7 screens in front of me, all of which have got the price action moving. I can see the interrelationships, and I think that's of primary importance. If you think about those markets that I just talked about, all of them in some way are related via a macro linkage, via a US dollar linkage. And sometimes, Anthony, when there is too much US dollar pressure in currency markets, for example, I might trade euro yen, or I might trade euro sterling, or I might trade sterling yen or something like that, or one of the Aussie crosses. And that's to take the US dollar part out of that move. And that way you can trade off what's happening with the yen versus sterling, and what's going on with the US dollar, whether it's up or down, becomes less important. And so that's how they're the primary markets that I look at. And when I'm looking at them, I'm looking at the interrelationships between them to see where opportunities open up, and those cross markets, whether you might be looking at Aussie and Euro and realise that there's a break in the linkage between the two. And for me, each day, because I'm in Australia, people want to know about the Australian dollar. So simple things like looking at the 10-minute chart of the Aussie versus the copper price, HGC, the Aussie versus the Euro versus the Chinese yuan, and how all those linkages tie together then informs my trading and my what markets I'm looking at. But you're dead right. You've got to stick to a certain number of markets. If you just jump in and jump out, you've got no reference point. Pardon me. You've got no reference point for where true value lies for that market if you're just trading on a momentum basis. Having said that, I know this is a long answer. If you do have just a simple, pure technical approach, turtle, breakout, that sort of thing, then having a diversified portfolio with 40, 50, 60 markets, I don't think is an issue. But if you're trying to do it the way I do, which is fundamentals and technicals, then you do have to build a relationship with the markets you're trading.
Okay, quick question before we start talking more about the technical side of your strategy. You said that you're trading roughly 10 to 15 markets. I totally understand how you chose them now, but what is your hold time for those markets?
So the charts that I look at are dailies and 4 hours. So I use exactly the same process for dailies and 4 hours. I work backwards I look at the monthly charts, then the weekly charts, then the daily charts, then the 4 hours. And so based on a 4 hour chart, I might hold a position for 1 day, or probably 12 hours to 3 days. And based on the daily charts, I might hold it for probably 3 days to 3 weeks, depending on how the trend runs.
You said that your strategy is both technical and fundamental. I think most people could figure out how you're getting to, getting your fundamental research. You go out and you're reading about what's happening in those markets. But on the technical side, I want to talk about that because that to me is very specific in your research. So what are your favorite indicators to use? You already gave us some idea of what chart you're looking at. And why did you choose those indicators?
So my most important thing, I guess, is that I'm a person who believes if your process works, it should work on all markets. So my normal setup for a daily chart would be candlesticks, MACD, stochastics, 15 and 30 EMAs, and that'll be on a 4 hour chart or a daily chart. And I got that from Jimmy Rohrbach. I heard him talk once, and he talked about how that was the best indicator any single person could have for just keeping stops, and that was important. That kept me from being bearish all the way through 2011 to 2015 on US stocks, which probably saved me a bit of money. And then trend lines, Anthony. I'm a big on trend lines. If I could only do one thing on a chart, it would be draw trend lines. And I know a lot of people argue with me about the relevance of trend lines, but I consider myself to be a behavioural economics and finance guy, and I think trend lines. A two-touch trend line is a tentative trend line. Once you've got more than two touches, other traders are looking at it. That's then when you can use it for support and resistance and, trade off and trade through. But my key and primary indicator, I guess, is the MACD. And when I start to see a turn in the MACD, so when the moving averages are starting to come back together, that tells me that the move is starting to stall. And then I try and take advantage of the next bar that breaks the previous high or the previous low with a MACD change in direction, and I run with that. That's my primary technical indicator above all else.
I want to follow up on the trend lines a little bit because you emphasize that, and it's funny. A lot of the people I've been talking with lately on this show really love trend lines, and what I ask all of them, and what I'm asking you right now, is what is it about the trend lines that you believe is giving you an edge?
So John Maynard Keynes said once that it's not important to know who's the best looking if you're judging a beauty contest. It's important to know who the others think is the best looking if the winner is the person that picks the one that everyone else is picking. And that's how I see trend lines. It's not just about sticking with the trend, because that's always important. And I would always emphasize that for the most part, for inexperienced traders in particular, you have to trade with the trend. My MACD system is a somewhat counter trend sometimes, and often actually. But the trend line thing for me really is just a way of encapsulating what's important to other traders. So if I've got a really important trend line that's had 5 or 6 touches, I know that I'm going to get a reaction next time it comes through. Most times it's going to bounce through. And I've got this thing that I call the McKenna mantra, which is respect levels and lines unless or until they break. But if they break, because it's had so many touches, because everybody's watching it, you also know you're going to get a reaction to the other side. So that's where I think trend lines are important. They tell you what other traders are looking at. And one of the things about foreign exchange, unlike futures, and this was the hardest thing for me to adjust, specifically from when I was an interest rate trader and could trade futures markets, is it's almost impossible to get decent volume data in foreign exchange unless you are inside a bank and you can see what clients are doing. And to that extent, trend lines at least help give me a sense of where positions are and what they're doing. So that's how I use them.
So candlesticks, MACD, moving averages, trend lines. To me, the picture that I'm painting in my mind about your strategy is there's a lot of discretion going on. You're looking at all of these things and you're basically trying to build a puzzle by looking at these indicators. Am I wrong, or is it more systematic in your approach and there's these things have to line up before you do anything?
Oh, no, they've always got to line up. I had a lot of time as a bank trader, swinging for the fence and thinking I was right and all that kind of thing. But these days, if the MACD hasn't turned or isn't turning, and if the current candle I'm on, whether it's a 4-hour or a daily, and my system works on 1-minute charts and 15-minute charts and 30-minute charts and weekly charts as well. But if I haven't got the MACD signal with a break of the previous bar, then I don't trade. And that's been a good discipline because it's saved me a lot of money. What I've discovered over the last 12 months or so is that my approach is very similar to Alexander Elder's triple screen, but also Bill Williams and the approach he looked at in Trading Chaos when he wrote that book back in the 90s, I think it was. I've got an original copy here, but I can't trade unless I get that signal. So all the other stuff is just fluff. When I get the signal, I take it.
Okay, so I get that. You have a checklist of things that you go through looking at those indicators to make sure they're all in line. Are you using any automation notifying you that these things are lined up, or is it all done visually by you looking at all of those indicators?
So that's a good question. It's probably something I should have talked about a little bit more about when I talked about process. I've got spreadsheets that I've built that take prices for many more markets than I actually trade, and then put them into a spreadsheet and generate all of the different levels and generate the signal. So I check those each morning. But I also, as part of that process, build up a backdrop of the technical indicators. So I haven't programmed it into Python or anything like that, but I'm probably going to put the 4-hour chart into some back testing soon and just let that run as an automated version, because that one seems, particularly in foreign exchange markets and oil and gold, it seems to work really well. So it's very systematic, but not yet automated fully.
Gotcha. So what is it about the strategy that you have put in place that you believe gives you that edge when you're going and trading?
Again, I think it's behavioural. So the MACD in particular gives you a warning that momentum has started to slow. And if you have a look at what I also do in many occasions is, if a market goes vertical and you start to draw those trend lines. So let's say monthly Nasdaq over the last couple of years, it's gone more vertical and more vertical, or the Turkish lira just recently that just went more vertical. What you get when you get that break in the trend line and the turn in the MACD is a clear signal of exhaustion. And the DMARC says that markets don't fall because of sellers; they fall because of lack of buyers, or they don't rise from a low because of it's because the guys that are running and the girls that are running that market, the sellers or the buyers, depending on which direction, they just get exhausted. And so for me, my process, my strategy is looking to take advantage of that exhaustion and of the reversal that you often see in that market.
Gotcha. So let's talk about your execution now. We've talked about the strategy itself. Now, if you could walk us through an entry, are you scaling in? Are you getting it all at once? Are you always trading the same contract size, or is it fluctuating based upon the situation?
Contract size is always a percentage of what I've got in my account. From when I was that was one of the most important things that I guess I've learned, is not to swing for the fence. So I'm a bit of a base hitter, I guess. So it's always an assets under management size. So sort of 1% to 1.5% is my maximum size position. And I know a lot of traders out there, they love leverage, particularly down here in Australia. The leverage available to traders is just through the roof. I'm not one of those traders. I prefer to build slowly. So it's always sort of between 0.5% and 1.5% is my position size. In terms of scaling, I've never been able to pyramid. I've never quite got that concept. So if let's say I'm having 5 contracts, which might be a 0.5% position for euro, I will do 5 individual contracts so I can scale out. So I'm not really one for scaling in, but I'm definitely one for scaling out, because I've got, in and of myself, I know that I find it difficult, and I think this is something a lot of traders might find. The hardest thing is not to have a stop loss and get hit on your stop loss. The hardest thing for me, and I think many traders, is to have a winner and let that winner run and run and run. And so what I tend to do is I have targets. I use Fibonacci for my targets, and then I'll probably cut half my position when I get to the original target, and then let the rest of the position run.
Okay, so those indicators we talked about before, that checklist that we gave was basically, what was it? It was MACD, trend lines, moving averages. Now you're using fibs, not for entries, but to help you get out of trades, for exits, targets.
Yes, very much so. So I don't know what it is about Fibonacci's why they work, but they tend to. If I put my behavioural economics and finance hat back on, I just say because everybody else watches them. There's nothing mythical for me about technicals. It's more that over the years we've all learnt to 38.2% or 50% or whatever it happens to be, and everybody tends to gravitate back towards those levels. So I will normally have my take profit. If I'm selling, for example, I'll have my take profit just ahead of the 38.2% retracement level for the move I'm looking at, for half the position or something like that. So it's more that other people look at them, and that for me is an important part of the toolkit for support and resistance.
Does the distance of your stop fluctuate, or is it always the same distance from your entry? And if it does fluctuate, are you adjusting the percentage of risk that you're going to put on that trade? Because you said that you use a percentage base of your account, or are you adjusting the contract size?
Yeah, so it's not the percentage that changes, it's the contract size. So if I've got a further away stop, I end up with less contracts. If I've got a tighter stop, I end up with more contracts, but the risk remains the same on each instance. Now, I'm lucky. I'm 30 years into this career. I've got a decent size account, and so I can have that 1 or 1.5% for traders who are kicking off their account. I would say use the same process, but you're probably going to end up with a bigger percentage at risk. And I'm not advocating someone swings for the fence and goes 10% risk in, but I can understand why somebody might, have a 2 or a 3 or a 4% at risk. But it's the size of the stop determines the contract size that I trade, not the other way around, because that's what drives into your percentage of assets under management. And what I've done is I've built a simple contract calculator. You know what the tick value of each contract is. You know what the current price is. You put in your stop. That tells you how many contracts to trade.
I love when you said that. I was thinking to myself, I'm like, you're not held by the same contract size. So if your account is fluctuating or your stop is fluctuating, you're always adjusting to where you are at the moment. You're not just randomly picking a contract size to trade. I love that.
No, absolutely. I think one of the most important lessons when I work with new traders is to explain to them that they have to get the right size of the trade, so in terms of percentage or contracts, relative to their account. Otherwise, they end up with this terrible seesaw pattern where they make good money, then they give it all back because they're actually trading far too large for their experience and their account. And that's one of the for me, the most important thing. Get your position sizing right relative to your risk appetite, your ability to go to sleep at night, and the size of your account, so that you don't blow yourself up. Because lots and lots and lots of traders, as we know, go out backwards before they get the opportunity to actually learn the game properly. So position sizing for me is a really important thing.
I want to move on and talk about something that you say in your trading. I've heard you talk about this before. You say you're constantly amazed at how traders don't get the linkage between drivers in one market and the impact on another. I think especially for you trading, foreign exchange markets, it's extremely important to watch other markets. But talk to us about this and how you think that this is something that a lot of traders just get wrong.
Yeah, so global financial markets are interconnected. They always have been. Jesse Livermore talks about trading corn and looking across to wheat and doing something in that. And these days, it's a similar process. If I use foreign exchange as an example, there's much chat these days about what the US dollar's doing and those kind of things. But there's not enough focus on the other drivers of foreign exchange. And people will say, there's no contagion in emerging markets. But one of the reasons the Australian dollar is down is because those emerging market tensions have been there. One of the reasons that copper is down, and that then feeds into a negative feedback loop with the Aussie dollar, is because that emerging market crisis and the tariff issue is then changing people's perceptions about global growth. And so, whether it's copper's relationship to the Australian dollar, whether it's the 10-year at 3%'s relationship with the dollar index, those kind of linkages are really important, because otherwise, if you're not lifting your head up from the screen to see what's moving around you, then you can get hit by the bus. That is somebody trying to hedge, their copper position with an Aussie dollar or something like that. So that for me is the primary importance. Now, I trade 4 hours and daily, and I trade foreign exchange. Each foreign exchange trade is a pair trade, Aussie versus US dollar, Euro versus US dollar. So I must look at different drivers. But I think it's just as important, to know what is happening in other markets and how they're related. Commodity traders do that perfectly, corn and wheat and soy and all those kind of things, gasoline and oil and those kind of things. People who trade those markets understand those linkages. But when I'm working with, new traders, that's the one thing besides getting their process right, that's the other thing that I tell them to do. Look up from the screen, look around at what's happening in the atmosphere.
Yeah, a couple things. I mean, this brings us back to the beginning on why you use technicals and fundamentals, because for you, if you're just watching your market, you could be missing everything that's happening, because there's this push-pull effect, when you're looking at currencies, foreign exchange markets. So one thing that I want to talk about with you is something that I do. Now, I primarily trade S&P, so I look at the Dow and the NASDAQ, and I primarily trade 10-year ultras, and I'll look at the 5-year and the 30-year, and even a little bit of gold and the dollar, to kind of throw in there, and I'll watch. And what I look for, and I'm curious if you do this as well, is let's just use the basic one for me, the S&P. If the S&P is hitting support, then I'll look to see if on my same strategy, the Dow and the NASDAQ are, to see if that gives me confirmation that my correlating markets are supporting what I'm looking at in the S&P. If they're not all at the support on my strategy at the same time, then I expect it could be bumpy. Are you doing something similar with your technical strategy? Find the markets that are correlating with or against your market to see if they're hitting the same, let's call it support and resistance levels. I know you're not using them, but areas that are in the market you're about to trade to give you confirmation?
As a secondary issue, absolutely. So I run through my spreadsheets, I run a correlation matrix every morning of 30, 60, 90, 180 and 365-day correlations, and I watch how they move. So I'm watching in that cross-market way that we just talked about, I'm watching what the key drivers are, and correlations move. So it's important to, and they cycle to see what is driving. So if Euro's moving, for example, to extrapolate from your S&P, NASDAQ and Dow, so if Euro's moving and Aussie's not, but Sterling's moving and the Kiwi and the CAD are, well, then I know that there's an opportunity for me to get in to maybe an Aussie dollar trade, for example, for it to play a little bit of catch up. And so I do that in a similar way as confirmation. And it's often the case, in a US dollar denominated world as we're in at the moment, where that's the primary driver of many currencies. If the euro is moving and sterling's moving, then there's a fair chance that the CAD will be. But a good example of the atmospherics is dollar CAD at the moment has diverged from the Aussie and the Kiwi because of the NAFTA discussions. So you need to be aware that is, making it more difficult to trade dollar CAD in relationship to the kind of strategy that we're talking about. But in general, yes, I look at other markets to see where they're going as confirmation, but then also I will use them if the correlation's broken down and I think they should come together. So last week, the euro took off, the Aussie lagged, and I put on a euro-Aussie trade to say that correlation would come together and that euro-Aussie would fall. So I use those opportunities too.
Yeah, I love it. Great explanation. Great stuff, Greg. We're not done yet. I have some rapid fire questions if you're ready for those.
Yep.
All right, everybody, our rapid fire segment is sponsored by Trading Technologies. Access the global markets from virtually anywhere with TT. They are the world's fastest commercially available futures trading platform. And now you can trade cryptocurrency spot and derivative markets side by side. For more information, please visit tradingtechnologies.com. Greg, first question for you. What trader has influenced your life the most and why?
So my old boss at State Super, when I was a fund manager, Peter Whitty, he took a raw young kid from the western suburbs and let me take risks, make mistakes, learn how to manage money. I blew up a couple of times, but he was there with a guiding hand, and he really subtly let me build my process and turn into the trader I am today.
What was one of the hardest things that you've had to overcome in trading?
I haven't overcome it yet, Anthony. Intellectually, I want to be right all the time. So that's why I've had to kind of get this really structured, systemized process, because this desire to be right, was really difficult to overcome. The other thing that I had to overcome, if I may, was that when you're a bank trader, you kind of get taught to double down if you're wrong, and that's completely back to front. So I had to reteach myself how to trade as well.
How has your trading process evolved over the years?
Started out as a fundamentalist, economics, trade flows, run markets, then started using a bit of fundamentals with technicals. The Asian crisis and the break of the pegs in 1998 was a great way to test charts and those kind of things. So I went from fundamentals with technicals, and now it's technicals with fundamentals. And when the fundamentals and the technicals line up, that's when I really get excited.
What is one attribute that you believe every trader should have?
Intellectual integrity and a bit of curiosity. The intellectual integrity bit is because you've got to be honest with yourself, and the curiosity because part of the process of trading is learning more about markets and testing yourself. So if you can do that and then have the ability and the discipline to stick to a process, I think you'd be well suited to be a great trader. Favorite book about trading? Reminiscences, stock operator, Jesse Livermore's book. But also, I was lucky enough in, I think it was January 2008, to read this book. It was a history book called The Great Wave. It was a history of inflation for the last 1,000 years, but it set me up really well for the GFC. And I was running a bank balance sheet at the time. So that's probably been the most influential book, but Reminiscences is definitely my favorite. Favorite movie about trading? The usual, Trading Places. What's the best piece of advice that you've received about trading? Get your position size right. That's not just as important. That's not just important for me about assets under management. It's the ability to walk away from the desk. If you can't walk away from your desk or you can't sleep at night, you need to cut your position. And so getting your position size right is a big part of managing the psychological journey of being a trader. If you could give a piece of advice to the younger you, what would it be? Get busy on your own account. It's easy when you're working for a bank or a fund manager and getting paid a pretty good penny to just concentrate on that. But if you can get busy within whatever regulations you've got on your own account, you'll be set to move on and be a private trader much sooner. Last question for today, Greg. What's your favorite thing to do when you're not trading? I live in the bush near the beach, so it's family, surfing, and then also I like to read about economics and market history as well. Where can people find you on Twitter, and give us a website to check out? Yeah, so on Twitter I'm at Gregory McKenna, and my website, just about to relaunch it soon, is www.gregmckenna.com.au. This was a blast, Greg. Thank you so much for joining me on Futures Radio Show today. It's been my pleasure, Anthony. I've really enjoyed it. Thanks, mate.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.